Hey, good afternoon. This is Scott Adams. Just kind of touching base with everybody. Hope you're all staying safe, being healthy. I've got with me this afternoon Richard Staley, Angel Oak Home Loans. We're going to kind of chat a little bit about some of mortgage relief options through the Federal CARES Act, kind of what's going on in the real estate industry and the lending industry. Just a quick 2 minutes of your time that is probably going to provide you some great information. So anyhow, Richard, hey, thanks for jumping on with me this afternoon.
All right,
you doing well?
Yeah, well, thanks for having me. And just really, I mean, you hit on really two big points. The the Forbearance Act that is allowing consumers to forego their payments for a couple months. That is, I don't think people realize the ramifications behind that, because these servicers, I mean, we have people that may close last month and then they send notice that they want a forbearance to their payment for the next 3 months, and the servicers still have to pay the bondholders, and the bondholders have to pay cash to the they have to pay. They don't have that money, so it's putting tremendous pressure on these servicers to a point that may put a few of them out of business. And if lenders can't lend and sell the loan to a servicer, then buyers can't buy. So
do you think that would tighten credit markets going forward, making home loans harder to get?
Oh, without a doubt, because there'll be no outlet for it. So it'll work its way from the top all the way down, and hopefully the next stimulus bill coming out has the servicers included, and they'll be able to survive. But it's a tough time right now.
So not talking about the guy who just purchased and then put forbearance just to kind of spread things out, but maybe somebody who did get furloughed, or whose business they're just their income was affected. What does what does this program allow for those individual homeowners?
Well, they can up to 3 payments, 90 days of forbearance. The problem we see with that is in 90 days. So just say this consumer has a $2,000 mortgage payment. In 90 days, they now have to pay $2,000 plus $2,000, and that's going to be a problem, because knowing how fast these people can get back to work and get the revenue. The big thing that people don't understand too is there's some guidance from Fannie and Freddie that if you do a forbearance and you want to buy a home within the next 12 months, you cannot get a home loan through the government agencies, because they want to see some time for you to get back on your feet.
Oh, so that's a pretty severe negative consequence too. So
it is big. So if you're in the house hunting mode, it will affect you based on guidance today in the next 12 months.
Right. Very good. Well, thank you for sharing that. So so what I'm hearing is, hey, should I not pay my mortgage or go through this forbearance program? If you can all avoid it, the answer is no, you should not do it.
Absolutely. And the big issue the servicers are having with, there's no guidelines. Anybody, you don't have to prove anything. You don't have to prove you're out of work. You just apply and you get the grant.
Right. Very good. So, this whole stay-at-home experience is, kind of a little hard to wrap your head around. It's a little bit new to all of us. My personal thoughts is this is going to cause, a recessionary event, albeit probably nothing anywhere close to 2008. But can you tell us a little bit about what you see the impact here to housing prices and and mortgages going forward?
Yeah, absolutely. I just earlier today I did a conference for a large amount of a real estate community office, and talked about. I'll share 2 slides with you real quick that can kind of really elaborate on what you're asking. So this is not a housing crisis. 2008, the financial sector, the mortgage companies, banks were just wild west. That has all been changed with the Dodd-Frank bill. This is a great slide Goldman put out about the GDP that you can see they put out a forecast in March, and then they changed it 5 days later, stating that they believe Q3 and Q4 in our world will be so much better, with obviously great growth. So our folks believe that we'll be just fine once we get out of that. And also too, and this is another, just to kind of refresh everybody's memory, that home prices actually really beyond that 2008, they've actually done very well. And we believe that it's going to, when we put this event on the slide, it's going to be great. I mean, 81, that was due to the monetary crisis when interest rates were 16.65%. 91 there, that was basically the oil crisis. And again, only 2% variance. That's not even really considered change. And then 2001, of course, 9/11, and the .com, and but they increased. And then of course you have this blip of 08. So R indicates with us.
You see 4 material recessionary events, and you see 2008, but the 2008 recessionary event was really based on in the mortgage industry and the
Exactly. The banks and the mortgage folks created that mess, and it was all done because of Wall Street's appetite to buy these mortgages, and it drove everything at the end of the day. Yeah.
But there's none of the underlying fundamentals that caused 2008 don't exist.
Absolutely. Yeah, we're absolutely regulated by the Dodd-Frank bill, ability to repay. Banks are good. Mortgage companies are great. We just have this unique incident going on in our life today.
All right. Well, yeah, I appreciate you filling us in. That actually was kind of my mindset as well, and kind of the way I saw things going forward. But to have other people reaffirm, just kind of puts a little more calm in all of our lives.
Absolutely.
Which is a nice thing. I appreciate your time, Richard. Thank you guys all for joining me. If you have any questions, feel free and call myself or Richard Staley. I'll put all of our information here on the bottom of this page. You guys stay safe, be well, and we'll talk to you again soon.
All right. Have a great day. Thank you, Scott.